What financial foundation means. Your financial foundation is your personal money safety net, a stable structure that protects you from emergencies, debt, and emotional decisions. It ensures that when you invest, even $5, you're doing it from strength, not desperation. Think of it like this. You don't plant a tree in sand, you plant it in solid soil. Investing is that tree. Your financial foundation is the soil. 1. Build a mini emergency cushion, even before investing $5. Why? If your car breaks down or you lose a job, you'll need money fast. Without a cushion, you might end up taking that $5 or $500 out of the market, or worse, going into debt. Goal: start small. Aim for $500 to $1,000 as a starter emergency fund. Eventually build up to 3 to 6 months of essential expenses. Where to keep it? In a high-yield savings account or money market account, where it's safe and easily accessible, not in the stock market. Tip: set up automatic transfers. Even $10 a week adds up. Example: if you save $10 per week, you'll have $520 in a year. That's your safety buffer before you invest. 2. Pay off high-interest debt. Why debt with high interest like credit cards is an investment killer. If your card charges 20% interest, it's like losing 20% every year. No stock market return can reliably beat that. Goal: focus on paying off any debt over 7 to 8% interest before investing. You can still start with small, symbolic investing, $5 to build habit, but your main energy should go to debt reduction. How? List all debts, interest rates, and balances. Use one of these. Avalanche method: pay off the highest interest debt first. Snowball method: pay off the smallest balance first to gain momentum. Example: if you pay off a $1,000 balance at 18% interest, it's like earning an 18% return, risk-free. 3. Create a simple budget. Know where your money goes. Why? Before you invest, you need to understand your cash flow. What's coming in, what's going out, and what's left to save or invest. Goal: control your spending so you have consistent savings available for investing. Ensure you're not using money you'll need next week. How? Track your expenses for 1 month. Categorize them: needs must, wants must, savings. Try the 50-30-20 rule: 50%, needs 30%, wants 20%, savings and investments. Tip: you can start investing that 20% savings portion after your emergency fund and debt are handled. 4. Protect yourself with basic insurance. Why insurance prevents a single unexpected event from wiping out your savings or forcing you to pull investments out at a bad time. Essentials: health insurance, covers medical emergencies. Auto insurance, required by law and protects your assets. Renters/home insurance, protects your property. Life/disability insurance, if someone depends on your income. Even if you invest just $5, insurance ensures one bad event doesn't cost you thousands, or your entire financial plan. 5. Set clear financial goals. Why? Every dollar you invest should have a purpose. If you invest without a clear reason, you may panic and pull money out too soon. How to set goals. Ask yourself, what am I investing for? Retirement, travel, freedom, education? How long until I need this money? How much risk can I handle emotionally? Time horizons. Short-term, 1 to 3 years. Avoid the market. Use savings. Mid-term, 3 to 10 years. Mix of stocks and bonds. Long-term, 10 plus years. Focus on stocks for growth. Example: if your goal is retire at 60, your investments can stay in the market for decades. Time smooths out short-term volatility. 6. Educate yourself about investing. Why? Even a $5 investment deserves knowledge. Understanding how the market works protects you from mistakes and hype. What to learn? How compounding works. Your earnings earn more over time. Risk versus return. Stocks equals higher risk, higher reward. Bonds equals lower risk, lower return. Diversification. Spread your investments. Use index funds or ETFs. Fees. Avoid high-fee apps or funds that eat your returns. Tip: if you invest $5 through apps like Acorns, SoFi, or Fidelity, you're not just investing. You're learning how investing feels in real life. 7. Start small, stay consistent. Why? Starting small builds habit and confidence. Consistency matters more than the amount at first. How? Start with $5, $10, or $20 per week in a low-cost index fund or ETF. Use dollar cost averaging. Invest the same amount regularly, regardless of market conditions. Focus on building the habit of investing, not timing the market. Example: $5 per week invested at 8% annual growth equals about $1,400 in 5 years. Not huge, but the habit and learning are priceless. 8. Review and adjust regularly. Why? Your life changes. Income, expenses, goals. So your plan should evolve too. How? Check your progress quarterly or yearly. Adjust your budget, debt payments, or investment contributions. As your foundation strengthens, increase your investing amount gradually. Final thought: before investing even $5, ensure that $5 isn't your last $5. A solid financial foundation turns every dollar you invest into a tool for freedom, not fear. In other words, get stable, get educated, then get invested.